the fourth rule is, if you want to be successful in investing, you have to learn to think independently. Okay. Now, why do most people lose money in the stock market? Because most people are sheep. Bah. Most people are creatures of conformity. Most people, what happens? They get excited when other people get excited. So when everyone gets excited, they get excited and they buy. And that's why they always buy at the high. When everyone gets scared, they get scared. Everyone sell, they sell, and they always sell at the low. So that's why they always buy high, sell low, buy high, and that's why they always lose money. All right. So to profit, you must train yourself to think opposite of the crowd. So like what Buffett has said many, many times, you got to be fearful when others are greedy. Right? Let me share with you a very interesting story. Okay, I'll tell you this story later on, right? But let me finish this first, right? And be greedy when others are fearful. So right now, let me ask you this. In the markets in general, do you think most people are fearful or greedy? Most people, are they pessimistic or optimistic right now? Yeah, most people are fearful. Most people are pessimistic. And that's why things are attractively priced. Okay. Now, this is easier said than done. How do you find this difficult to do? Right? Why? Because remember, as human beings, our biology is programmed to follow people. Because in ancient times, it was important to be with people, right? Because if there was like a saber-toothed tiger in the wild and you're with a group of people, then it's safer, right? But in modern times, it causes you to lose money in the markets, right? I would say that, I'm lucky because ever since I was young, I was always an oddball in school. I could never follow people, right? When everyone goes right, I always go left. When everyone goes left, I always go. I was always the odd one out. That's my character. And it's because of that character that has helped me to become a really good investor, because that's how I can keep buying when everyone is selling, right? So, but if you're not like that, if you don't have that character, can you train yourself? Can you learn to be like that? Yes or no? Yes, you can. Okay. And it's not easy. That's why we've got the community of investors where we chat every day and we remind each other to be rational, to be logical, to follow the rules, okay, and not be sucked in by the crowd. All right, everyone? So I don't know how many of you have watched my YouTube video on this, but I found it very entertaining that if you look at history, you find that the best time to buy is when people are very upset. Okay, so I call this my sad face indicator. Anyone remembers my sad face indicator, right? So every time the market crashes and the media shows a very sad face, okay, and in the title of the news, they put the word worse. You need to see the word worse here. When you see the word worst day, worst week, worst month with a sad face, you just buy. You just buy. Okay. Now, you may still go lower a bit, but usually it's near the bottom, right? Not all the time, but very often. So again, on the 28th of October, when the market, on this day, sad face, buy. Hallelujah. Right? Why? Because that's how human emotions work. The market tends to bottom at peak pessimism. When the last person throws in the towel, when the last auntie jumps off the building, that's when the market usually tends to bottom, right? Again, over here, look at that. 20th July 2021, market, and right at this day, another sad face. Look at the sad face. Look at his face. If they cover the mouth, it's even better, right? And then again, worst day, right? And you bought there, hallelujah. Okay? So I'm sure you've seen this before. This is called the psychology of a market cycle. Remember, the market always goes up, but it doesn't go up in a straight line. It moves in cycles of boom and bust and boom and bust, bull and bear and bull and bear. Okay? And during the bull and bear cycle, what are the emotions that come up? These are the emotions. So you notice that At the start of a bull market, do you think people are optimistic? Never, never. At the start of a bull market, people are always in disbelief. They say this will fail, the market will fail, right? That is usually the start of a market going up. And then as the market goes up, people start to have hope. Ah, there's hope. It could be recovering, right? And then it keeps going up. People start to get optimistic. This is real. Okay? Then it gets higher. People start to have belief. Time to fully invest, all in. Then it goes even higher. Thrill. You know what? I got to tell everyone to buy. I got to tell my father, my mother, hey, everyone buy this. And that's when people start buying on margin. That's when they borrow money to invest. And then the final stage is euphoria, where they say, I'm a genius. Making money is so easy. When you hear people around you tell you that making money is easy, that everyone is making money in something, that's usually the bubble. Okay. And sadly, this is where most of the most unsophisticated people jump in. And that's when it collapses. All right. Into, panic, capitulation, anger, depression. And it's when everyone gets depressed, everyone gives up. They say, I don't want to look at stocks anymore. I don't want to look at this anymore. It's all, it's over, right? And that's when the bull market starts again. Okay. So I tell you a funny story. I've got an auntie who's extremely conservative. And all her life, I think, for the last, 40, 50 years, she has never bought a stock. She has never bought any fund. She just holds cash. That's it. All right. And last year, I think it was last year. Yeah. She called me suddenly and she said, Adam, I want to ask you something. I was like, what? Because normally she doesn't call me because she's not interested in investing, right? And she said, Adam, I'm thinking of buying Bitcoin. I was like, huh? You want to buy Bitcoin? She says, yes. I said, why? She said, because all my friends are buying it and I see that, it keeps going up. So I want to buy Bitcoin. And at that moment, Bitcoin was at, I think about 50, 60,000, I think it was $62,000. It was at that point, she said, I want to buy Bitcoin. And in my mind, I was like, okay, this is the end. And sure enough, boom, collapse. Okay. It is so easy to see, right? That when the last auntie buys something, it collapses. But the opposite happens, right? When the last auntie jumps down in desperation, that's normally when it bottoms, okay? But I can't say the same for crypto because, again, I've got nothing against people who buy crypto, really. I've got great friends who own crypto. But my concern is that crypto is a non-productive asset. It doesn't produce anything. It doesn't generate cash. Like if you own real estate, you can rent it out. It generates rental. If you own shares of a business produces goods and services. It generates profits. It makes something. But crypto is a non-productive asset. It doesn't make anything, right? So the only way to make money in crypto is that you have to sell it to a bigger fool who's willing to buy it from you at a higher price. And that bigger fool who bought from you must find an even bigger fool to pay a higher price. And that guy must find an even bigger fool, right? So it's a greater fool's game because the asset itself doesn't produce anything. All right. So I'm not referring to crypto on this, but I'm just saying that these emotions happen. But in the stock market, it will always go up because you're owning productive assets that are generating more and more corporate earnings and cash flow over the years, right? Let me quote this guy called John Templeton. Now, John Templeton, he's retired. Sorry, not retired. He's dead. he's passed away, right? And he's one of those legendary billionaire investors, together with Warren Buffett and Charlie Munger, right? So how did he make his first millions? So John Templeton made his first millions investing during the Great Depression. During the Great Depression, that's when he started investing. When everyone said, we're all going to die, he was buying stocks at huge discounts. And then he became a billionaire later by investing during World War II. As you guys know, Warren Buffett himself started investing at the age of 11, and he bought his first share during World War II. So if you take a look at all the greatest investors in the world, the ones that have made fortunes, what they all have in common? They started buying during crisis, Great Depressions, wars, World War IIs, or whatever it is, right? And they continue to buy aggressively during future crises. So what John Templeton is famous for saying is this. He says, bull markets are born on pessimism. When everyone is pessimistic, that's when a bull market starts. And they grow on skepticism. When people are skeptical, oh, it's going to fail, it keeps going higher. Bull markets mature on optimism and they die on euphoria. When everyone is excited, that's when the bull market ends. So the bull market is like sex. It feels the best just before it ends. Okay? So the time of maximum pessimism is the best time to buy. And the time of maximum optimism is actually time to sell. Right? So again, this goes against human psychology. This goes against our natural instinct. That's why most people can never make money in investing, because they follow their natural instinct. You want to make money in the markets, you have to go against your natural instinct. But you have got to have rules, obviously. You cannot just buy crap companies. You've got to buy very good businesses. So that's when the investing course comes in. That's why you have to learn the investing course to know how to read the business models, how to read the financial statements, right? But then you need the psychology to act on it, okay? Tracy, thank you. Appreciate that compliment, okay? Are you guys still with me? Yeah, great, okay. Psychological trait number 5, never attempt to predict the market. Why? Why shouldn't we attempt to predict the market? Because the market cannot be predicted. It cannot be predicted. Okay? Now think logically. Think logically. Why can't anyone predict where the market will be in 1 week, 1 month, 3 months? Now, don't get me wrong. In the long run, the market will always go up. Okay? It will always go up. But in the short term, no one can predict exactly where it's going to go. Why? Because think about it. What drives the price up and down every day? Demand and supply, right? So if there's more demand than supply, price goes up. If there's more supply than demand, price goes down. Now, what drives demand and supply? Is it logic or is it emotions? Logic or emotions? How many of you agree emotions, right? Now, we like to think that we are logical. We like to think that we are rational, right? But the reality is this, most of the time, people make decisions based on emotions and they justify with logic. I mean, think about it. How many of you are married? Now, why did you get married? Did you get married was it a logical decision? Like, okay, I need to marry this person in order so I don't feel lonely, I have a companionship, so I can, have a dual income. I marry the person so that I can propagate my genes, my gene pool can diversify. No, right? You get married because I'm in love. I love her, right? It's emotions. And then you justify with logic. So same thing. Most people, they buy and sell stocks based on emotions, not logic, okay? Now, here's the thing. Can emotions change like that? Can market sentiment change very fast? Yes or no? Yes. So what changes the market sentiment? News, right? Like a month ago, when Xi Jinping had the 20th Party Congress, a lot of the media was saying a lot of bad things, that, they're going to have COVID zero forever. Xi Jinping is a dictator for life. And people panic, oh my God. And then the China market crashed. Remember that? And a lot of people I know, they panicked, they sold at the bottom. And then what happened shortly after? The news changed. Xi Jinping went around the world. He went to the G20 summit and then say, hey, Biden, hey, brother, what's up, brother? And he started making friends with everyone. And they're going to start to phase out the COVID. And then the moment the news changed, the China market went up very fast, right? And those that sold at the bottom was like, ah! So the moment news comes out, the sentiment can shift very fast. And by the time you saw at the bottom, you got to get back in at the top, which doesn't make sense. Now, let me ask you this question. Can you predict tomorrow's news? Can you predict the news next week, next month? Of course not, right? So if you can't predict the news in the future, how can you predict people's emotions? How can you predict what the Fed is going to do? How can you predict what Xi Jinping is going to do? How can you predict what Biden? You can't predict, right? And so if you can't predict news, you can't predict emotions, you can't predict the market. Think logically, right? I don't know about you, but I've been married for 22 years. And before that, I was with my wife for 7 years together. So I've been with her for 29 years, right? Now, I can't even predict my wife's emotions the next day. I mean, she can go to bed very happy, smiling. Next day, she wake up, black face, scold me. All right. Now, if I can't even predict one woman, how can I predict the emotions of millions of people in the world? It's bloody impossible, right? So you got to get this in your mind. No one can predict the market. But the problem is when you read financial news, what do all these people on TV do all the time? They make predictions. Oh, the Dow Jones is going to this place, the S&P is going down, or gold is going up. They make all the predictions, which is full of crap, okay? So the market cannot be predicted, and any attempt to do so leads to bad performance. Having a predictive mindset causes us to not follow our investment rules. Our job, let me move this first. Our job is not to predict the short-term direction of the stock market, but to invest in great businesses that would collectively grow under all economic conditions. Like for me, I own McDonald's. One of the stocks I own is McDonald's. I own Nike. I own Estee Lauder. Why? Because I know recession or not, McDonald's, Estee Lauder, Nike will keep growing their sales and profits. Recession or not, high interest rates or low interest rates, whatever happens, these companies, they will keep growing and the share price will keep going higher over time. I don't bother to predict what's going to happen in the short term. Okay. Now, let me show you something very, very important. Do you think that making money in the stock market is easy? Or rather, let me rephrase that question. Do you think that making money in the stock market is simple? Iris says no. Lauren says no. Dawn says no. Shinima says it's hard. Rachel says no. So most of you say no, except someone says yes over there, right? Now, here's what I say. Making money in the markets is very, very, very simple. It's so simple. A blind, one-legged monkey can do it. But it's not easy. I repeat, it is damn simple to make money in the market, but it is not easy. Why is it not easy? The thing that stops you are your emotions. So let me give you an example, right? Take a look at the S&P 500 over this period, right? So this is 2009 to end of 2021, right? So this is about 13 years, all right? This is about 13 years here, right? So you can see the S&P 500 in 13 years, it went up 846%, okay? In 13 years. An idiot could have made 800% just buying and holding the S&P 500, okay? But let me ask you this. Do you think that a lot of people who invest made 800% in these 13 years? No. Many people in these 13 years did not make money, or they lost money, or they only got a fraction of this. Why? You want to know why? Do you want to know why? Because they read the bloody stupid news and they read the stupid predictions of people. So let me show you all the news articles that came out during these 13 years. Are you ready? Okay, let's start. Now, some of you would have watched this before, so it's a good reminder, right? So this article came out in 2010. This is July 2010. This was from the New York Times. What does it say? It says, a market forecast that says take cover. With the stock market lurching again, plenty of investors are nervous and some are downright bearish. Then there's Robert Preacher, this clown, the market forecaster and social theorist, who is in another league entirely. Mr. Preacher is convinced that we have entered a market decline of staggering proportions, perhaps the biggest of the last 300 years. Holy shit. Can you imagine if you read this article, would you have dared to buy stocks here or held your stocks in 2010? Would you have dared to do it? No. Why? Because this guy who's a preacher tells you that the market is going to have the biggest crash in 300 years. You wouldn't have bought stocks. You would have sold in panic, yes or no, and missed out 800% return because of the preacher. Now, not just this year, every bloody year. Let's look at the next year. Next year was 2011. What did the news say? S&P lowers its outlook. Could US default on its debt? So now they're saying that the US government could default on their debt and the US government is going to shut down, which it did twice, right? And people say, Adam, how can you buy US stocks? The government's going to go bankrupt. Then 2012, now they say Europe debt defaults are poised to rattle stocks. So now they're saying not only is the US in shithouse, but Europe is in shithouse, right? The Eurozone debt crisis. And then the next year, 2013, they said US default seen as catastrophe, dwarfing Lehman's fall, that the crash will be worse than 2008. And then the next year, 2013, another old dude, right? He says, doomsday poll, 87% risk of stock crash by year end. 10 predictions, worse plunge than 2008. Why? Bad news sells articles. Next, 2015, this guy called David Stockman, he said stocks and bonds will crash soon. How can you not listen to a guy called Stockman? I mean, he was born to talk about stocks. He's not crypto man. He's not bond man. He's stock man, right? And then the next year, 2016, analysts say here comes the biggest stock crash in a generation. And then the next year, 2018, why markets are still heading for crash. Every bloody year, they tell you the market is going to crash. Now, question, will the market crash once in a while? Will the market crash eventually? Yes, of course it will. Of course the market will crash once in a while. But if you keep saying it's going to crash every year, obviously 1 year is going to crash, right? But if you keep reading this crap, guess what? You never dare to buy shit. Okay? Now, again, look at that. 2019, are you still prepared for a crash? Now, let me show you something. This year, 2022, there were people who said it's going to crash as well. And yes, it did crash this year. All right, fine. So they're right in 1 year, right? Fine. But let me ask you this. If you see, even with the crash this year, look at this is the crash this year, right? This is the crash. Even with the crash this year, you would still be up 699% from 2010. Do you know what I'm saying here? So what I'm saying is the trouble is many people, they read all this doomsday porn. And this Robert Kiyosaki is one of the king of porn, king of doomsday porn, together with his friends, I don't know, right? And if you keep reading this crap, every year they say the market will crash, right? And you would not have gotten in. But if you just stay invested, and buy good companies, even if it crashes once in a while, hey, you're still up 700%. You're better off than other people who just hold cash and lose money from inflation. Okay, number 6. Now, this goes against what many of you may have learned in school, right? If you studied finance like me, you studied economics like me, you may say, hey, this goes against what I learned, right? But again, if you study the greatest investors in the world, the ones that are the most consistent in building their wealth, they all say the same thing. Pay no attention to macroeconomics or geopolitical events. Okay? Now you may say, but Adam, macroeconomics is important, right? Interest rates and inflation and GDP, that affects the stock market. Isn't that important? Yes, it's important. But the problem is, it is unpredictable. So there's no point focusing on something that's important, but there's no way to predict. Even the best economists in the world can't predict whether there's going to be a recession. Even the best economists can't agree whether there's a recession. Even the head of the Federal Reserve can't predict future interest rates. So what chance have you got? What chance do I have got? So let me show you the next chart. And again, this is the S&P 500. And like I said, in the long run, it always goes up. It always goes up, right? But the trouble is, most people can never make the most money from the potential of the markets because they always find a reason to sell. Okay. So in the investing course, I tell people that the only reason to sell a stock, is if there's something wrong with the business. If the business has fundamentally changed, then yes, you sell it, reinvest in something better, right? Or if the stock is way overvalued, sell it, take the money, reinvest in something cheaper. But never sell because of some macroeconomic prediction or because of some geopolitical prediction, because all these are short-term. They don't last very long, okay? And when you sell because of these reasons, very often you have to buy back at a much higher price, which is really dumb. So if you take a look again at the S&P over this period of time, it went up 495%. But look at all the bad news during that time. GM Chrysler files for bankruptcy over here. Most powerful earthquake to hit. Flash crash. A European sovereign debt crisis. US government shutdown. Ebola virus. Brexit. US elections. Charlottesville. S&P 500 enters a bear market. US government shutdowns a second time. Trade war. Yield curve inverts. Iranian bombing. Emergency Fed injection into the repo market. There's always something to worry about. There's always a problem in the world. Always. Tell me when there isn't a problem, right? So like what Peter Lynch said, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. So 7 psychological rules is risk management and capital protection. Now, most people, before they buy a stock, what's the first thing they think about? What's the first thing they think about? They think about how much money can I make? It's going to go to the moon, right? But great investors, like me, great investors, or whether it's Buffett or these people, right? Before they buy a stock, what's the first thing they think about? They don't think about how much they're going to make. They think about how much could I lose? They always think about how much they can lose first. And if they feel that, hey, this business could lose me money, they don't invest. So for me, I follow 2 rules. Rule number 1, my first rule for investing is never lose money. Write this down. Rule number 1, never lose money. So if I analyze a business and I think that there's a chance that I could lose money, no thank you, I'd rather not invest. I will only invest if I'm confident that I can't lose on this investment. All right. So rule number 1, never lose money. Rule number 2, how do I get the highest returns from safe companies? So I rather not make money if there's a chance of losing money, right? So, I mean, if my number 1 rule was to make money, I'll buy a lot of things. Again, I would have bought ARK, I would have bought Zoom, I would have bought Beyond Meat, I would have bought Airbnb, I would have bought all these stocks, I would have bought crypto, I would have bought all these things, but I didn't. Why? Because I knew that it could go up, but it could also lose money. No, thank you. So number 1 is always protect your capital first. That's the most important thing, right? So now, even if you pick companies which you know are very safe, can shit still happen? Can shit still happen? Yes, shit can happen that you can't predict. So again, for example, I invested in Boeing. And Boeing, I bought it before the pandemic. Great business. Make more money every single year. It's a duopoly with Airbus, right? So when I bought Boeing, I said, there's no way I can lose money. It's a great company. But what happened? Right? Two plane crash. And then the 737 MAX got grounded for 2 years. They couldn't sell the plane. And then with the pandemic and airlines were grounded, they didn't order planes. And Boeing, for the first time in history, lost money for 2 years. Negative cash flow, right? And the bloody share price dropped 80%. And I own that stock, okay? So even if you're so safe and you buy good companies, shit can happen that you just can't control, right? But although my Boeing dropped 80%, the stock price in 2020, but overall in 2020, I still made money. My portfolio was up 40%. Why? Because I diversified. That's why it's really important. You got to diversify. Don't put all your eggs in one basket. You have to own a portfolio of at least 8 great companies. At least 8. I mean, it can be more than 8, right? It can be 8 or 10, but at least 8. Okay. So that if 1 or 2 of them go down temporarily, shit happens, doesn't matter. The rest will go up and make up for it. Does this make sense? And the good thing is I'm still holding Boeing because I believe that the problems are temporary and they're now solve the problems. Now the 737 MAX can fly again. China's ordering planes again. And now Boeing is beginning to rebound and it's above my cost price already. So I'm already profitable with Boeing, right? So it's about a diversification. Okay, very, very important. Yeah. Okay, last one. Last one, like I said earlier on, is this. Question, in investing and in life, will you make mistakes? Will you make mistakes in investing and in life, in relationships, in business? Of course you will. But the most important thing is to understand what's a mistake and what's not a mistake. So let me ask you this. If you analyze a stock, it's a great business, right? Meets all the investing criteria, and you bought the stock, but the price dropped 20% next week. But nothing wrong with the business. Business is fine, but the price dropped because of the sentiment. Did you make a mistake? Is this considered a mistake? Yes or no? That's right. The answer is no, it's not a mistake. Why? Because like I said, you have no control over the market price in the short term. And where the market price goes is random based on news. So it's not a mistake because it's still a great business. Understand? So that's not a mistake. So don't feel bad if the price went down after you bought it. There's no reason to feel bad because you have no control over it. You know what I'm saying? But if you bought the stock of a great business and after you bought it, you realize, shit, I made a mistake. It's not really a great business because it failed this step. It failed that step. I made a mistake. Now, is that really a mistake? Yes, then that's a mistake. Then you should sell the stock. Okay? Or what if after buying the stock, the fundamentals change and the company lost its competitive advantage? Like, for example, let's imagine you bought McDonald's, okay? And then after you bought McDonald's, 1 month later, the whole world decided to become Hindu. In case you don't know, Hindus don't eat beef, right? So let's say the whole world became vegetarian, right? Right? And now, shit, now I got McDonald's, right? And people aren't going to eat Big Macs anymore, right? So is that a mistake? Yes, that's a mistake. You sell. You understand? So you've got to know what's a mistake, what's not a mistake, all right? So once you make a mistake, you got to sell. Regardless of whether you sell below or above the purchase price, you just got to get out immediately. Don't hold on with blind hope. Hope is for the hopeless. Get out, take the money, reinvest in something great that can grow and not get stuck there for centuries and it's an opportunity cost, right? So never stubbornly hold on to a lousy business. Never blame other people, never complain, never give excuses, because only losers blame others. Only losers give excuses. Only losers complain. Okay? Winners take responsibility, they learn from their mistakes, and they move on with their life. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.